All right, 1400 hours. You're watching Nedbank Business Watch. Welcome to the program. We hope you're having yourself a good day. We promise to give you a very insightful program as we continue to track the latest in the business development of the Kingdom of Eswatini. My name is Sifiso Mmal and I'm with Lungelele. Lungulu, how are you doing?
I'm good. Good. How are you?
Doing all right. Just,
great.
Worried about the temperatures that we have been experiencing these past couple of days, but nonetheless, I'm doing all right.
Yeah, all right. And good afternoon to our viewers. Thank you for tuning in. This is Nedbank Business Watch. We are live on our YouTube page, Eswatini TV. On the program today, we talk about investing. We take you back to an interview Sifiso had with Nedbank's Zama Ngwane Dlamini, breaking down the difference between investing and saving and the available products for the ordinary consumers. Do stay tuned for this interview. And then later on our final segment, Sifiso Nsibande from Nedbank joins us for an analysis of today's markets. Do stay tuned.
Yeah, and of course, we do focus on the Finance in Focus by the Finance Minister, Honorable Neil Reichenberg, who has said in his Finance in Focus episode for the month that Eswatini's GDP ratio currently stands at 45%, and he describes that as a safe position. He does elucidate and mentions that SADC member states recommend 60% rather GDP, a threshold rather below 60% under the GDP ratio. We do want to talk to Stanley Bia, who is our economist, to really understand whether that 45% is a level we want to maintain or we want to go below that as we continue to look at what it means for the economic development of the Kingdom of Eswatini. That conversation coming up on the program today. Otherwise, it's 3 minutes after 2. You're watching Nedbank Business Watch.
Digital helps you make cross-border payments. Human gives you global specialists. Digital allows you to apply for a loan anytime, anywhere. Human connects you to credit experts. Digital puts you in control of your money, while human connects you to wealth advisors. Digital allows you to freeze, unfreeze, cancel, and reorder your card. Human gives you that personal touch. Digital when you want it. Human when you need it. Get the complete private banking experience with Nedbank Private Clients.
Welcome back. This is Nedbank Business Watch, and now for our business news.
Again, we look at Finance Minister Honorable Neil Reichenberg, who says Eswatini's debt to gross domestic product ratio, which currently stands at 45%, is within manageable levels. The minister says government is in a good space to pay debts and continues to have the capacity to meet her financial obligations. Reichenberg was speaking during the ministry's Finance in Focus program, where he provided insight into the country's debt position and government's ability to manage finances.
We try to always manage our debt around the 45% debt to GDP ratio, which has been creeping up over the years. But at the moment, we are still trying to maintain those levels. As we speak, we are trying to raise a bit more debt to be able to deal with arrears and deal with outstanding payments. But it is still in very safe territory at the moment. I think the average on the continent is 66% debt to GDP ratio. SADC countries have said we shouldn't go over 60%. As a country, we're on 45% debt to GDP. So from that perspective, we're still in semi-safe territory, and we'd actually like to keep it that way as a country. We don't want to go too high. As a country, if we are seen as conservative, it means that all the banks in the world are wanting to loan money to Eswatini, and they want to try and maintain that so that the private sector can thrive, parastatals can thrive, government can continue to loan money when they need money, and loan money cost effectively. And so that also is a factor, also trying to make sure that our cost of debt is maintained at good levels. At the moment, we're doing very well. We don't have commercial debt with international entities. So, and again, one of the very few countries on the continent that all of our foreign debt is concessional debt. And so we managed to maintain that, and that stands us in good stead when it comes to repaying our debt, being able to afford to repay.
The creative arts industry in Eswatini is expanding rapidly, with more artists, innovators and entrepreneurs producing original works than ever before. As artificial intelligence and digital technology continue to reshape the creative landscape, the importance of protecting intellectual property has become even more pronounced. The Copyright Office continues to encourage creatives to register their works to protect their rights, secure ownership and benefit financially from their talent. This next story highlights the types of intellectual property and why it matters within the creatives industry.
We have about 5 categories of IP, intellectual property. We have copyright, which protects expressions, original expressions. We have trademarks that protects brands. And then we have patents that protect innovations. And then we have designs that is responsible for protection of what is aesthetically pleasing, the environment, patterns, and packaging. That's where industrial designs come in. And then we have trade secrets. Trade secret, that is where we protect confidential business information, because as you know, if you're in business and everybody knows how your competitive advantage, you'll not succeed. You will lose that competitive advantage. So trade secrets is for that, to protect what makes your business tick over your competitors. There is an advantage to registering with the IP office, or alternatively with the Copyright Society. Certain advantages, for instance, it gives you proof on the date and time of registration, because we then give you a certificate that proves that you are the original, that original idea belongs to you.
Meli Hlanze, the Executive Director of the Eswatini Copyright and Neighboring Rights Society, Eswakos, an organization responsible for protecting local intellectual property, enforcing copyright, and collecting royalties from musicians, writers, and artists, emphasizes the need to register with the society.
Currently, we have over 400 people who have registered. We have over 400 members at Eswakos. And the benefits of being a member of Eswakos, firstly, is the fact that we will be collecting royalties on your behalf. That basically means that if anyone or any business or entity uses your work without permission, then we'll collect royalties for you and we'll be able to pay you those royalties. This could be digital royalties, this could be royalties from broadcasting and so forth. The other benefits, and recently you might have seen, we have development grants, the Creative Industries Development Fund, which helps us to support creators beyond just giving them royalties. We will have other funds like an Artist Mobility Fund that will support the movement of artists to attend, for example, networking events, to attend conferences outside of the country, and also to showcase outside of the country. We will also have a social welfare fund.
Melusi Dlamini, chairperson of A Peculiar People, best known for creating the Made in Eswatini ecosystem, including the Made in Eswatini Consumer Fair and the Eswatini Consumer Choice Awards, says intellectual property is a powerful tool for driving innovation and building strong local brands.
We had to lead the way by actually protecting the mark of Made in Eswatini before we actually start licensing it out. Why we do that is so that we can be able to license it out to other people before they use it. We also, want a situation where we're able to protect who uses it, because it's very important for us to make sure that whoever uses the Made in Eswatini mark on their products, on their brand, on their services, we know it is, and they maintain a similar standard. So what we really always emphasize is for entrepreneurs to create these ideas that will outlive them. And it's important to always protect and register with the IPO office.
Artists, entrepreneurs, and business organizations continue to share success stories of how registering their intellectual property has protected their creations, opened new business opportunities, and generated sustainable income.
Ukubhalisela music wakho through letinye ama-copyrights ngondlela nalo kugcina ukuthi at least ungawukhanzi so udlalwa umuntu awuthini so usetshenziswa ngulenye artist.
Musician Celumusa Mkhaliphi says registering his music has enabled him to earn royalties every time his songs are broadcast, including airplay outside Eswatini, demonstrating the tangible benefits of protecting creative work.
We look at it from a perspective of assets, basically. Most of the time people just tend to think, when you just have a logo, you're done. You know, people must just already know that that is yours. But without a legal paper trail, you still don't necessarily own that. So anyone who can just show up and register that brand of yours before you will own it. And now you have to borrow your own brand from somebody else to register it. So it's quite important that as an asset, your reputation is one of your key business assets. Now, trademarking your work protects you from duplication, from counterfeiting, basically. And it gives you a step forward in terms of business, because other businesses want to work with someone who has a track record, someone who understands the nitty-gritties of shares, of, positioning yourself.
As the creative industry continues to evolve, even in this digital age, the Copyright Office in the country states that registering intellectual property is no longer optional. It is a strategic investment that protects creativity, preserves ownership, and ensures creators receive the recognition and rewards they deserve. The African Regional Intellectual Property Organization, ARIPO, states that a strong intellectual property system enables inventors, researchers, entrepreneurs, and artists and businesses to protect and commercialize their ideas. This encourages continued innovation, creates employment opportunities, strengthens industries, and improves competitiveness in both regional and international markets. Reporting, Nelson Langamandla, Fuminkosi Nzinisa, Ezulwini.
All right, and that's it for our business news. It's 13 minutes after 2 p.m.
After the break, Sunny, let's be our economist in conversation regarding that finance in focus story that we just watched, that 45% debt to GDP ratio. How safe is it? Stay with us.
Attention retailers, importers, clearing agents, and customs brokers. All television sets and decoders entering the Kingdom of Eswatini now require mandatory ESTVA authorization before customs clearance. No clearance without valid ESTVA import permit. Don't risk delays at the border. Submit your application 24 to 48 hours before your shipment arrives. We process complete applications in just 1 to 2 working days. Our QR-coded permits make the verification quick and easy. Always double-check your HS codes and quantities for smooth compliance. The process is simple. Step 1. Submit your completed application form. Annex A with product line items for TVs, decoders, and commercial invoice. Step 2. Eswatini TV reviews and approves. Step 3. Make payment and complete verification. Step 4. Receive your permit. Step 5. Clear customs smoothly at the border. Make sure you have all your required documents, a completed application form, Annex A detailing your product line items, commercial invoice, valid TV retailer license, and letter of authority if applicable. Our permits feature QR codes for easy border verification. For assistance, email us at license@eswatinitv.co.za or call our help desk. Apply before your shipment arrives. Ensure compliance and avoid delays. Remember, all TV sets and decoders entering the Kingdom of Eswatini must have a valid ESTVA import permit. Thank you. Act now.
All right, welcome back to the program. In our first story, we reported that the Finance Minister, Honorable Neil Reichenberg, says the country's debt to gross domestic product, our GDP ratio, currently stands at 45%, a level that he has described as a safe financial position. The minister says SADC member states have recommended that countries maintain debt to GDP ratios below the 60% threshold. He adds that Eswatini's debt to GDP ratio remains below the continental average of 66%. But, what does that really mean for the country's economy? Is a 45% debt to GDP ratio truly a safe and sustainable level for Eswatini? Sanele Sbia, our economist, is in studio to really help us to help us understand this development. Thank you so much for your time, Mr. Sbia. Minister Neil describes it as a safe position. But maybe before we debate whether indeed it's a safe position or not, maybe let's explain what a debt to GDP really measures, as well as why economists pay so much attention to it.
All right. Thank you, Mr. Ngumalo. Good afternoon to you, and also good afternoon to the viewers at home. So when we're talking debt to GDP ratio, we are looking at how much of the country's economic output is actually supposed to go towards paying that national debt. So the thinking is. And as the economy grows, you are able to gather more taxes, and you're able to pay for that, for that debt. So that is why economists look at that. It somehow gives us a what you would call your gross income as a country, because that is where you are going to be getting the money to pay your taxes. The same thing as a household. We look at your gross payment, at your gross salary. Then we give you a loan depending on how much you can pay. We look at that leverage. So what it essentially means is you are collecting tax from the output that you're producing as a country, and you need to use that tax to fund the government of business and also to fund this public debt. So that is why we look at it and see how feasible it is, and it's mostly the capacity to repay more and beyond the ratio. We then come into looking at what we call the capacity to repay the debt. Right. Yeah, not just the debt to GDP ratio figure, because it's not the GDP that pays the loans.
So on that topic, our capacity to repay the debt within the 45%, which we currently stand at, one wants to ask, because government in Eswatini, through Minister Neil Reichenberg, obviously points to that 60%, which is the SADC benchmark, and he says we are well below that threshold, and he says it's a safe and manageable position. Is 45% automatically a healthy position, Sanele, or does that conclusion depend on other economic factors?
Yeah, it's one of the things I've been particularly worried about. We've been seeing this shift, Nxumalo, towards, this high debt appetite coming through from government. If I take you to last year when we were below 40%, the minister was always saying he's below IMF targets, IMF and World Bank targets of 40%. So now we've exceeded the 40% and we need to find another safer, cautionary type of sentiment to use so that we say, we are below our regional peers, so that means we are in a relatively safe position. But safety doesn't really depend on what everyone else is doing. If everyone else has gold that they can mine and they can sell it for exchange rate and for foreign exchange and be able to pay off their debt, their ability to repay that debt is not really, constrained by the amount of GDP that they're producing because they have mineral wealth. And then if you also need to look at how much government needs to pay this debt, and you look at our fiscal purse, you'd realize that we get a lot from SACCO revenues. Around over 30% of the budget comes from SACCO, and then that right now won't even be enough to cover public servant salaries, just the wage bill alone, right? And then you have ERS expected to collect around, I think, 20 billion this year, but it's above 18 billion. So now that's what government needs to repay the loans, pay school, provide social services, and do every other thing that government does. So now when you're asking the question whether it is safe or not, it's a question of saying, can government be in a position to pay off the debt and service these debts while at the same time providing adequate social provisioning and ensuring that the business of government goes on without any inhibitions? You are able to pay off areas to the private sector and do everything comfortably. Now, that is when we would say you are comfortable. But once the debt goes to a level where you now start to talk of cash flow problems, because when debt is due, it is due. If the IMF or whatever entity borrows you money, expects their money in June, they just expect their money in June. You have to send that money. So now you have to think of the impact on the country's cash flow projections and how the debt servicing affects that as well. So you realize that the more debt we accumulate, the more the word cash flow problems within government becomes quite prevalent.
Right.
So now that is what we need to look into.
So you are juxtaposing our current debt against our current fiscal purse, its capacity as well. And you want to, in fact, you are disagreeing with the sentiment that 45% is a safe position. Are you agreeing at least that it's manageable?
I would say it is manageable if we wouldn't have to go out there every day to get a budget support loan. Because that means right now we always need to get some external funding. And now that's pushing our deficit to around 8% of GDP. So that means government constantly needs to go and borrow around 80 cents of every langeni that we are going to spend. Okay, let me not put it that way. But government has to go and borrow just to balance up the budget right now. So what this shows us is we are going to go into a perpetual state of borrowing just to balance up the budget.
Sometimes borrow just to pay off another debt. Which is very unhealthy.
It's not healthy.
And initially you did mention that we have gone from celebrating that we are well below 40, which is the IMF benchmark, and having seen that we have since went above the threshold, we have found another benchmark to sort of pat ourselves to say, we are still necessarily safe, a term you do not want to use in this conversation. But perhaps, you speaking on other measures of our fiscal health beyond the debt to GDP ratio is a very important conversation I feel like we should really get into in terms of what other indicators should we be looking at to assess the country's public finances.
First up, Mr. Nxumalo, I think one of the the scariest is if you are now spending more than you are paying to educate your people just to service your debts. now that's a problem. It's a country that shows
it should be the other way around.
Yeah, we should be spending more on education than on debt service costs.
Right.
But right now, if you take the budget estimates and look at the budget, you'll realize that debt servicing now exceeds the education budget. So now that's a red light that we are saying as economists, no, we need to rethink our debt strategy right now. And another issue that you look into, Mr. Nxumalo, is this debt actually producing the GDP? So when you're looking at jumping from 40 to 45%, now that's a huge jump, not just in percentage points. If you're now to do the 45 minus 40 over 40, you'll see the real change in the GDP, in the debt stock, in percentage terms, and then you look at economic growth averaging around 8%. So it seems our accumulation of debt is now exceeding and outpacing the growth in GDP. So now that means we are investing. We are not seeing the return on investment in terms of our public of the debt, and that is why I was saying, you know, I really don't lean towards more of these budget support loans, because it's money that comes to support the business of our government. It doesn't really come to invest in productive capability, because what you want to do, the reason we look at debt to GDP ratio is we want to have the productive capacity, which is the GDP. If you're able to grow this productive capacity, make sure that it outpaces the debt level. So that means you are always a step ahead of your debts, and it would never grow to these levels where it's above the 45%, because for every debt that you're taking, you should expect congruent growth, or even a greater growth and a greater multiplier effect. So that is the things that we're looking into now, to say, you know, we need to rethink our debt strategy. Whenever we go out there to take out a loan, we need to ask ourselves, how much is it going to contribute to GDP? How much is it going to contribute to productivity? And most fundamentally, how much is it going to contribute to the tax pool? Because it is the taxes that pay the money. It is not the GDP numbers.
So what's more concerning right now in terms of our debt affordability, if you like? Is the bigger concern the size of the debt itself, or the cost of servicing that debt, particularly in a high interest rate environment?
It's a bit of both, Mr. Nxumalo. Number one, it's the size of the debt. The debt is now too much.
Quite seismic.
Yeah, it's quite seismic. So we ask ourselves if we are going to sustain our trajectory, the 5% that we are looking for. And that is why in the present moment, because we already have the debt, that's why I'm now advocating for government delivering the projects on time and making sure that we get this economic growth that we need. We need to think long term now. The debt problem is there. But if we have a debt problem and we're also not delivering the growth, what you're going to end up with is a situation where the economy is not growing, but the debt is there and requires payment, right? But if you grow the economy, then you're able to bring this figure down, even if you're not taking in new debts. But if the economy is growing, the debt to GDP ratio somehow comes down and stabilizes. It would go down to even that 40% level if the economy grows by the numbers that government is looking into. So that's why we need to overhaul the whole public procurement system and deliver programs on time and make sure that we deliver them on budget, so that we are not accumulating any debt on projects that we've already started as a country. So now that's the most pivotal one. And then there is the other one in the low field, which has to be delivered as well, to make sure that, because when you looked at the studies, it said it could there's a potential to create around 260,000 jobs, right? So now that could solve the problem of unemployment. And
which is that was the industrial park? Which one are you
not the industrial park.
Lower Makutu?
Yes,
okay,
the Lower Makutu.
Yeah. Okay.
So what you need there is to deliver those projects and deliver them on time and at cost, and make sure that you are able to unlock this growth, this catalyzing effects around it, so that you have more people into employment and you are creating a vibrant economy.
So on the topic of, because you have mentioned two things. You have mentioned, I think critically, you are, I think, emphasizing the urgency to finish projects on time.
Yeah.
And you know, the cost of not delivering them on time, I think you have also given us a clear picture on what that is. But I also want us to look at what essentially remedies the current problem when projects are delivered on time. It's not just delivering the projects on time, but it's essentially what the projects then bring as ROI.
Yeah.
Is that so?
Yeah.
So if you make an example of the ICC, a project that has been delivered, yes, not on time, but the big question now is it doing the work? Is it bringing in money?
Exactly. That's the productive capacity that we need to ensure that we lean towards as a country. When we invest and when we borrow money, we need to borrow and make sure that we are building productive capacity. If we had the ICC delivering and hosting a conference every week and every day and contributing this, say, 50 million that the target that it has, you realize that essentially that project would, in a way, be paying itself off, and you don't need to then dig into the public purse to make sure that you are paying that, because it's essentially paying itself off.
So in 30 seconds, just give us a summary of this conversation with regards to, this 45%, yes, not safe. What does it really mean? Tell us what it means in 30 seconds.
So it means, as a country, we need to come with our own number so that we manage our economy based on our numbers and economic conditions. So
let's be our economist, understanding the 45% debt to GDP ratio. I personally understand it much more clearer right now, and we need to do more work as the Kingdom of Eswatini. Projects must be delivered on time so that we are able to have our productive capacity at a much higher level than it is currently. We'll go for an ad break now. We'll be back shortly with a catch-up conversation with myself and Zamangwane on investment. Welcome back. You're still watching Nedbank Business Watch. Thank you so much for staying with us. Our conversation today with Head of Branch Networks from Nedbank Eswatini, Zamangwane, is centered around investing, which is one of the very essential topics, but very overlooked in most cases. And a modern poet, which is a rapper, has said before that scared money doesn't make money. So you do want to invest your money. So let's demystify the myths around investing and make you motivated to invest whatever it is that you are saving on the side. Zamangwane, thank you so much for joining us on the program. Perhaps I want us to start here. Nedbank loves to interact with customers across different income levels, right? Are you seeing a shift in how the ordinary Liswati or how the ordinary Emaswati view investing in particular?
Good afternoon, Mnguni. Thanks for having me. I think your quote just is running through my mind. Yes, we are seeing a shift in how Emaswati view money. In fact, we really appreciate that the conversations are happening. The conversations must happen. I think money is relatively tight for all of us, and as Nedbank, we believe that we are the financial experts. So we always want to help customers and consumers understand how to manage their money better, and also how to grow their money. I've mentioned that money is tight. So of course, we start to think of how do I get to save for the future? How do I make a saving when an expense goes up? Or we're in a situation now where we're seeing even fuel prices are going up. So in turn, even the cost of goods will certainly go up. Emaswati are alive and conscious to what options do I have and how far does my money take me currently?
Yeah, a very tight fiscal space for almost everyone, and you're right on that one. But there's often the conversation around starting small.
Yeah.
I want to understand how Nedbank is enabling its customers there to really begin investing even with the modest amounts.
I think you are touching on it with respect to some of the misconceptions that people would have around investing. One would typically assume that you need to have a lot of money to start investing.
Yes.
But to your point, you just do need to start small. So in terms of if you have maybe 300 malangeni or 500 malangeni, it is important that you actually start putting away what you can actually afford. And over time, that amount grows as long as you maintain consistency. And it will help you to fulfill and close some of these fiscal gaps that you are mentioning, or also moves you a step closer in terms of some of your financial goals and aspirations.
Absolutely. From a Nedbank perspective, how do you help clients understand the difference between saving and investing, and why both are important?
Yeah, so savings and investments are closely related. Sometimes it's difficult to make a distinction, but the key difference is that they're usually for different purposes. So saving is typically for your short-term needs in terms of your short-term financial goals. So that's either you're saving for a holiday, you're saving for some immediate expense, school fees, uniform, groceries even, and even if we are saving for a full tank for every end of the month. Whereas investment is more of a long-term goal. So that's when you are saving for bigger financial goals, whether you want to buy a car or make a hefty deposit on a car or a property purchase, as an example. So basically, we say that it's important to have both of them because they serve different purposes. Short term, in the savings, maybe for your emergency kind of expenses that may arise. You don't know what will happen at any point in time, so you want to create a buffer for yourself.
Absolutely.
And then investments as well, it serves a different purpose because you have a specific long-term goal that you want to attain and you work consistently to get to it.
Yeah, and so how do you propose Nedbank comes into the play now in supporting its customers in building that, what you call a balance between short-term financial security as well as long-term financial or wealth creation?
I think it's important to have conversations with yourself that are honest with respect to how you want to, what you want to attain. Is it wealth creation that you want to attain? And then, or is it an immediate cushion like we've spoken to? And what are you actually saving or investing for? So in terms of what we present as the bank is basically options that fit different risk appetites. Our risk appetites may not be the same between Zama and Sfiso.
Yes.
Our goals may also not be the same with respect to what we are saving for and how long we want to save for. So those are the key things that you would want to actually ask yourself and align in that. But in terms of the offerings, of course, there's a spectrum of options that fit those different variables to say, is it short-term, long-term savings, accounts, notice deposit accounts, fixed deposit accounts, retirement annuity, unit trusts and shares. All of those are options that build wealth creation or create a buffer depending on your immediate need.
Let's talk to that first-time investor walking into a Nedbank branch today or tomorrow, whatever. How do your teams then guide them in choosing the right product for their needs? I mean, you mentioned a plethora of products there.
So I believe that your need is actually what helps us to determine. Remember, I did say that we are financial experts and we also want to help you create your financial risk. But underpinning that, the initial guidance would be to say, start simple, with as minimal or as low a risk as possible. So these options can include, fixing your money for a fixed term, which means putting away the money and knowing that you're earning an interest. You're earning interest or compounded interest over a period of time. Or a notice deposit account. That's more medium term to say, I'm going to put away funds for a certain period of time and I'll give the bank notice when I want those. But those funds, whilst they're placed there, are actually earning you a return as opposed to sitting in your purse or under a mattress.
Absolutely.
Yeah.
There's often a conversation around time and discipline. And that's very key in investing, right? That's what you say.
Yeah.
how would you say Nedbank then encourages and supports a culture of consistent investing among its clients?
I would say that you mentioned the element of time, and probably time is the best indicator and probably the most powerful tool to have. Time is always of the essence, and we always say start early and start consistently, because the benefit of investing is that you earn the interest, and when you earn, you then start to earn compound interest. Yes. So what that means is that you earn interest on the fixed amount that you've invested, and then you earn interest on the interest that it's earned as well. So if someone starts saving at 20 years old, over time, even if they are saving smaller amounts vis-a-vis someone who might start saving or investing at the age of 40 as an example, but they're putting in larger sums, you would find that the one who started much earlier with the smaller amounts is actually making more based off of the time elements, because their interest has compounded significantly. So that is where then the time element comes in to say you start to grow your wealth more. And the consistency ensures that this wealth is actually growing consistently as well. Yeah.
So while you speak to the 20-year-old. I love the example. You're making an example of a 20-year-old and a 40-year-old, and you break down how compound interest can be life saving for both of them, but particularly for the one who started early. And it just makes me wonder, because we often hear people who get into employment early say, I want to enjoy my money first. And, do you want to talk to that person, that young person right now?
I do want to talk to that young person. I mean, just last month we were coming from the Global Money Week, where we raised awareness on this. I do want to talk to the young person, because there's not a right time, if I may say. The only right time is now, or immediately, when you come to that realization. Though I made the example of the 40-year-old, it doesn't mean that we can't start today. And also, it doesn't mean that you have to start investing with a large sum of money, or I can't afford it, or I'm just not the investing type, etc., whatever you may tell yourself. But I would say, yes, start small. If you want to enjoy your money, and you're enjoying your money as the 20-year-old, then surely you want to enjoy your money for a longer period.
Absolutely.
So you want to create a fund for your enjoyment. Make it be consistent. Allow yourself to have a consistent life of enjoying. So I would recommend that they absolutely do save. They've just started working, like you've said. They consider options of short-term and long and medium-term type of investments. They create emergency funds at a minimum, so that should the fund go a little bit lopsided, they have a cushion to bail them out, if you may. So I would recommend that they just maintain the consistency. There are various options in the market, and there are various options that are sold by banks and financial institutions that would fit that profile of a customer. So it's all about, once again, determining your needs. What does that 20-year-old want in 3 years, 5 years, 10 years? Or what do they want in 6 months or a year? That's part of this enjoyment phase.
Absolutely. So I take it that next to time, the next critical thing is discipline.
Correct.
Because that informs the consistency, and the consistency is essential, as you put it, right? But from your experience, what would you say are some of the most common mistakes that your customers make? And then how does Nedbank come into the play now to make sure that these people avoid these pitfalls?
Yeah, I think we've just touched on some of these. Common mistakes. It's the voices in your head to say, actually, I don't make enough money. I'll start investing when I make more money, or I'll start next year. And we're having a conversation at an apt time. It's Q2. Let's review our, what do they call them? Goals.
Yes.
What are the goals that you've put in for the year? Let's take stock. Am I still on track? Am I still doing what I wanted to do? Are my financial aspirations still in order? And it's okay to start over. So do start over, and anytime is appropriate time. But also, I do want to stress that the longer you have or listen to these voices or delay, then you lose the element of time that we've just spoken to.
Yeah.
Which means that the value or the creation and wealth that you're trying to build or create is also slightly impacted. But that's not to say that you can't build the consistency and add additional income into your savings and investments.
Absolutely.
But those are the common mistakes that we find. We also find that people may not understand the risks associated with some investment options. So I would also encourage customers to do their due diligence, to research, to find out what works for them, to understand how the products work for them. I mean, we see a lot of cases of bofaqata as an example, where you know, something seems too good to be true. Invest 300 and we will triple your money in 2 weeks.
Just, come on now. Yeah.
So those kinds of examples should be red flags and triggers of going off. So you have to be sure that you understand the risks. You have to be sure that you are comfortable with the risk you're taking in terms of the appetite. When will you get your returns? How long will your money sit there? And do you understand what potential risk there could be there with respect to the interest that you earn and the like? Yeah.
Absolutely. So I take it quarterly reviews, if you will, of your goals, very, very essential. But also being realistic about your goals and ambitions, very essential as well. Imposter syndrome, you know, that time that is delayed, you're saying it's not denied, but it's very important to know how to have that conversation with yourself. And I think if you're able to, you know, vet those mistakes and make an informed decisions, then you'll be good. I want to give you just one last opportunity to speak on whatever I may have forgotten to ask you about, because we're done with this conversation.
Yeah, I think I want to reiterate the 3 things that we spoke about with respect to choosing your investments. Reevaluate what's your financial goal. That's the first one. So you must make sure that you determine what is your goal. Also, how long are you willing to put your money aside for? So is it short term? Are we saving for emergency, or are we saving for a long-term goal? And then how much flexibility do you need? Will you need the money immediately, now, or how would you want to access your funds? And how would you want to contribute to your funds? So those are the 3 main things that I would highlight in terms of the selection or the choosing of investment options, and then the consistency. Keep in mind the consistency, the diligence, the discipline that we've spoken about. It doesn't help. Your quote is talking about risk to some extent, but also we see a note that, you know, you'll put away some money in a savings pot or whatever the case may be, but when you feel like, I'm really broke and it's a week before payday. So you start to tap into that, and that sort of erodes the discipline, because part of the discipline is invest, tuck the money away, but also learn to live within what is then remaining. That's why we encourage that you save what is affordable to your pocket. Don't overstretch yourself.
Don't overstretch yourself.
Yes.
Absolutely. Zama, thank you so much for your time. Zamangwane Dlamini, Head of Branch Networks from Nedbank Eswatini, decided the most powerful tool for financial growth, and that is investing. And there you have the conversation. You can make an informed decision as you invest, whatever it is that you can invest. Very important. Let's go for a net break. The show continues when we return.
All right, welcome back. Thank you for staying with us. This is Nedbank Business Watch. And now for our final segment, we're joined by Toba Kamete from Nedbank for today's market analysis. Toba, very good afternoon. Thank you for coming through to Nedbank Business Watch. So, yeah, let's start off with the global conflict. President Donald Trump did say they had a meeting that had discussions with Iran, a successful one, that is, but Iran is disputing that. How has that meeting shaped markets today?
Thank you, Linda. Good afternoon to you as well as our viewers. So Trump yesterday said that his administration had good conversations or good discussions with Iran. Iran disputed that. However, the market yesterday then reacted positively to that. We saw the dollar, weakening with expectations of inflation easing if that happens. So that has sort of then given gold a head start. We saw the price of oil also goes down, and then as I've mentioned, the dollar weakened. However, today we did then get reports of an attack on Saudi oil tanker in the Red Sea, which then sort of retracted some of those gains that we saw from the comments that were made by the president yesterday, which is why then we are seeing oil shooting up and gold shooting up as well today at the back of the conflict or the incident that adds to the conflict.
Yeah, so still in the U.S., October employment numbers are expected to come out. What can we really anticipate?
Yes, so we have ADP employment numbers coming out later today, but I think the most important print is the one that comes out on Friday, which is the non-farm payrolls, which sort of gives an indication to the market of job openings in the U.S. to say that is the economy growing, are there employment opportunities that are being created in the economy. So the market is waiting to see what those two data prints are going to look like, as well as the inflation that is going to come next week. I think the Fed in particular is going to be watching that closely for its next interest rate decision.
Yeah. All right. So coming back closer to home, just before you get into the numbers, coming back closer to home in South Africa, any data that has to be released this week? What can we expect this week?
It's been a quiet week on the data front, and it's going to be for the rest of the week. We did get producer manufacturing index, I think, today, but that number really did not have any effect on the indicators, as the rand mostly take its cues from international news or international prints and news that are happening.
Yeah. So as you said, Trump's discussions shaped up the markets today. Let's take a look at how commodities are trading this afternoon.
All right. So in terms of commodities, I think as I've mentioned, gold and oil are both up significantly, I would say. All above 2% increase. Gold at 4,166.7 per ounce, and oil at 90.03 per barrel. So that is just the gain of the strength that both commodities had lost yesterday after the reports that came out today that there was an incident or an attack on a Saudi tanker in the Red Sea by Yemen's rebel groups. So that sort of then retreated the sentiment that was coming out in the market that a peace deal is in the books. But nonetheless, we still observe to see what is going to come out. Saudi Arabia has not responded as yet on that incident. And I think as the trading day opens in the US as well, they've just started trading now, probably going to then see more reports or news and reactions on that.
All right, so moving on to currencies this afternoon. How is the US dollar trading against the rand?
So it's quite steady, just low drops against the major currencies, trading at 16.3950 against the dollar, 18.9281 against the euro, and 22.0960 against the pound. All of it really due to international news and what is happening globally. Otherwise, no specific indicators indicators that are moving the needle from a South African perspective.
Okay, so moving on to equities. Lastly, the S&P 500. What's happening today?
Yeah, so equities are doing quite well. The S&P 500 up 1.79% and the FTSE up 0.2%, and the JSE All Share also up 1.4%. It's mostly mining stocks that are performing quite well. I think this morning Glencoe reported that their projected earnings for the year are likely going to go up by 86%. So then that shot up their share price, as well as Next, a clothing retailer, also leading the pack with 6% increase in their share price as they report their second quarter earnings, which are quite good. So it's mostly on the mining side, as well as on the retail sector. Yeah.
Yeah. So just lastly, before I let you go, to about on the global conflict with what's happening now. What can you anticipate in the coming weeks?
So it's quite difficult, especially when we get such contradicting statements from both parties, with the US saying that they had good conversations with Iran yesterday, and actually Qatar saying that they, as a mediator, the mediators are saying that there is good progress, but then you have Iran on the other hand refuting that, which then sort of then does not give you confidence. And then the incident that happened today as well, the attack on a Saudi tanker, in as much as we are getting these reports, but as we get those reports of incidents or contradicting statements, it then leaves a lot of uncertainty. But overall, we just watching closely to see what is going to come out, and hopefully a resolution is reached, so that we can start seeing normalcy in terms of the energy sector, in terms of oil and fuel and all those things which affect our daily needs as Bantu.
All right, thank you, Toba, for your insight. Well, there you have it. This was our final segment with Toba Kamete. 2 minutes before 3 o'clock, we've come to the end of our episode. Thank you for tuning in. If you've just joined us, worry not, you can still watch this episode on our YouTube page. And if you want more information on investing and saving, do visit any of the Nedbank branches countrywide. We'll see you next week Wednesday at exactly 2 p.m. Enjoy the rest of your day.
Digital helps you make cross-border payments. Human gives you global specialists. Digital allows you to apply for a loan anytime, anywhere. Human connects you to credit experts. Digital puts you in control of your money, while Human connects you to wealth advisors. Digital allows you to freeze, unfreeze, cancel, and reorder your card. Human gives you that personal touch. Digital when you want it. Human when you need it. Get the complete private banking experience with Nedbank Private Clients.
Make better money choices. Choose a bank that takes your money seriously. Business Watch was brought to you by Nedbank.